Hey, guys, what's up? What's good? What's going on? Trust you're great. Welcome back to my YouTube channel. And yeah, without wasting any much time, we're gonna dive into what we have for today. And on today's video, we're gonna be talking about chart patterns and how to trade these chart patterns profitably, right? Um, right. So if you're watching this video, you're gonna learn how to trade chart patterns, how to understand them, how to apply these strategies on the forex trading charts, trade them profitably with strict risk management. Right? There must be strict risk management. So everything you need to know about chart patterns. This is like literally the most complete video on chart pattern. This is like the most complete video on chart pattern. So without wasting any much time, let's dive into what we have for today. So I'm gonna start with the definition of chart patterns. So what do you understand by chart pattern? When you hear the word chart patterns, what do you understand? Right? So I'm gonna read it to you. It says that a chart pattern or a chart pattern is a price action pattern within a chart when prices are graphed, right? It's a price action pattern. A price action. What is price action? The upward or downward movement of price within a particular period of time. So it's it's a price action pattern within a chart when prices are graphed. That's in forex trading, right? Chart pattern studies play a large role during technical analysis. When data is plotted, there is usually a pattern which naturally occurs and repeats over a period of time. So when data is plotted in price, there's usually this pattern, this particular pattern that occurs and repeats. So it means that this pattern occurs, it repeats, it shows itself over and over and over. Like they say, history repeats itself. This pattern repeats. You might see this pattern this week, and when you come to the chart to trade again next week, for example, this head and shoulders, you might today being Wednesday, you might see this pattern today. And when you come back tomorrow, next tomorrow, or next week, you might still see the same pattern, right? So one thing you need to know, guys, is that this pattern, these patterns, all these patterns, they don't always play out. Note that I'm not a financial advisor, so whatever I say in this video is for educational purpose only. These patterns don't always play out. They play out most of the time, but not every time. So you need to manage your risk. That's why I talked about risk management. If you know how to manage your risk, risking at least at most 1% per trade, you're gonna trade these patterns profitably, right? So let's continue with what we have. These patterns sometimes determine the general direction of price, can be used for market forecast or prediction. Using these patterns the right way, coupled with strict risk management. You don't risk your whole account, you risk 1% of your account. Using strict risk management can make you become a profitable trader over time. Over time, you don't just hop into the market expecting to make millions in a day. No, you trade over time and make profits, right? You take losses, you make profit, but make sure your profits are more than your losses. And yeah, so right, so let's these chart patterns can be categorized into two, right? We have the continuation patterns and we have the reversal patterns. So what are the continuation patterns? The continuation patterns indicate trend continuation, showing us that price will continue in a particular direction, such as an uptrend or downtrend. So it shows that price uh, will continue in a direction. So, like this bull flag, this is a continuous pattern, a continuation pattern. The bear flag is a continuation pattern. This is a continuation pattern for an uptrend, for downtrend, an uptrend, for downtrend. So this is a reversal pattern, right? So what are the reversal patterns? These indicate that price has a high probability of switching its trend from one direction to the other. So one direction could be an uptrend and the other direction could be a downtrend. So from an uptrend to a downtrend and from a downtrend to an uptrend, that's your reversal patterns. From an uptrend, a pullback, a continuation to an uptrend, that's your continuation pattern. From a downtrend to an uptrend and from an uptrend to a downtrend, that is your reversal pattern. Guys, if you're enjoying this video, do well to smash the like button and subscribe, turn on notification bell to get more videos like this in the future. So, right, what else about these patterns? We have the types of chart patterns. We have the flag, the wedge, the symmetrical triangle, the head and shoulders, inverse head and shoulders, double top, double bottom, triple bottoms, cup and handle. We have this cup and handle, right? So we're gonna move into explaining these chart patterns, right? We're gonna move into explaining these chart patterns. So, what is the flag? The flag is a continuation pattern. I read to you. A flag has a name, resembles a flagpole because it is in it is an impulsive bullish price movement. Price will impulse up, form a sideways correction, right? Okay, it impulses up, forms a sideways continuation that signals towards price is ready to continue its impulsive nature. On the breakout of the flag, you must wait for this break of structure, the breakout of the flag to happen impulsively before you take your trade, right? So that's the bull flag. A bear flag is the opposite of a bull flag, right? A bull flag occurs in an uptrend, a bear flag occurs in a downtrend. It resembles an inverted flag as price has just impulsed to the downside, formed a tight continuation pattern, resembling a flagpole, allowing us to forecast the next impulsive leg to head to the downside, right? So that's the flags. So let's talk about the symmetrical triangle. A symmetrical triangle is another form of continuation that we can classify as we analyze price action. It resembles a flag that is being compressed or squeezed out of its structure. So instead of being slanty, it gets squeezed. So this could break out either way. If it breaks out above, you look for buys. It breaks out below, you look for sales. So let's talk about the wedge. Oh, okay. Let's talk about the bull channel or bear channel, or we can call it the ascending channel or descending channel. So the typical characteristics of an ascending channel involves three touches, right, on both the bottom and the top, paired with corrective nature throughout, indicating a potential reversal of price is in play. A potential reversal. This indicates that price has a high probability of switching from uptrend to downtrend, and this is the opposite of this. High probability of switching from downtrend to uptrend. And how do you trade this? You wait for the trend line break, price to break the trend line before you take your trade. So we have our wedge. A rising wedge is a continuation pattern that resembles a squeeze of price on its way up. right? Each touch of the pattern becomes closer together. Each touch of the pattern becomes closer together, just like this triangle. But this indicates a continuation, right? Yeah. And this is the opposite of this is for an uptrend and this is for a downtrend. So let's talk about the head and shoulder. The head and shoulder pattern is one of is one that is used in many different strategies and is a common pattern market wide. It resembles an actual head and shoulders, which with the head being the second greatest of a structural level that and the right shoulder forming the third greatest of that area to head towards the downside. So this indicates a reversal from an uptrend to a downtrend. And yeah, the inverse head and shoulder is just the opposite of head and shoulders from a downtrend to uptrend, with your right shoulder, head, left shoulder, break, retest, drop, with your right shoulder, head, below, left shoulder, head, right shoulder, break, and above. So let's talk about the double top. The double top is the second rejection of the top of a structural significant area. So let's say we have a structural significant area, a support zone above, and we get this a double top. This is the secondary test of a second rejection of the top of a structural significant area. With a breakdown confirming the reversal, it is a common pattern that is traded market wide across multiple different strategies within the forex market. However, the way that we approach the double top is very different. Understanding price behavior on a much deeper level. So we don't approach these double tops and double bottoms just like a normal way other people, other traders do. We approach it professionally. Then we have a triple bottom, just like the double top, but with three touches, three rejections, and triple top with three rejections. Opposite of this, so these are just almost the same thing. And we have the cup and handle. This is a reversal pattern that shows the price reverses from a downtrend, switches to an uptrend, gives an impulse, a correction, forming the handle, and boom, just like this impulse correction. So let's talk about this impulse and correction, right? So to further understand the impulse and correction, you need to check out my videos on market nature. You need to check out the videos I made on market nature to understand this impulse and correction, right? So about this impulse and correction, we need to have an impulsive phase, a corrective phase, and then a breakout. So to confirm that price is gonna continue its bullish nature, you need to wait for a breakout of this trend line to take your trades from here. From the breakout, you have your stop loss below this pattern and your take profit. What should be your take profit? Your take profit should be the pole. The length of this pole should be your take profit, right? Your take profit from here should be the length of this pole. So your target should be the length, and your stop loss should be below the pattern, right? But sometimes you can actually trade from this third touch. Let's say you can actually trade from this third touch, but that doesn't confirm that price will go up because you're trading from a risk entry. It's very risky to trade from there, but you have a tight uh, stop loss below with your take profit, the length of this pool from here to here, because you are starting from the below this, have your target, right? So that should be your take profit. If you're gonna trade from the risk entry, and if you're gonna trade from the reduced risk entry, which is from the break of the trend line, you know what to do. So without wasting any much time, let's dive into what we just explained on the main forex chart. So let's let's dive into what we just explained on the main Forex charts. So this is the daily time frame, right? This is the daily time frame. Let's switch to a 3 hour time frame for a better understanding of price. So this is the 3 hour time frame. This is the 3 hour time frame. What are we seeing here? What are we seeing? As you can see, we had this double top here, right? This is a double top. This is a first top, second rejection, drop. So this is double top, right? Um, we had this descending channel, and we broke above, right? Yeah, we had this triangle pattern, symmetrical triangle. We broke below, right? We had another double top here. What happened? We dropped, right? We had an inverse head and shoulder. We had an inverse head and shoulder, left shoulder, head, right shoulder. We had a double bottom here. First rejection, second rejection, move to the upside, push. So this double bottom, you could have bought here, placed your buy order, and had your take profit here. You see, TP smashed, right? Um, so what do we have here? This pattern, it's not actually visible. Um, we had our bull channel here. What happened after our bull channel price dropped? We had our flag. This is a bear flag. This is a bear flag. Uh, we had a triangle pattern here. So guys, you need to trade these patterns with the trend. You know what they say, the trend is your friend. You need to trade these patterns with the trend. So this actually looks like a triangle pattern, right? Or you could still adjust this to here and this to here. So one thing you need to note, guys, is that price is fractal. Price action is fractal. You can get one price action within another price action. So let's say, for example, this triangle pattern, you can see a flag pattern inside this triangle pattern, right? And you can also see a double top inside this triangle pattern and the head and shoulder inside this triangle pattern. So let's start with the head and shoulder. This is like the inverse head and shoulder. Price moved up, right? And this is another head and shoulder. Price dropped. What do we see here? We do see a flag. We do see a flag pattern, right? A flag pattern. What else do we see? We see a double top. Price dropped, right? That's that's it. That's it. What are we seeing here? we can see this bear channel with the trade touch. Price has broken above, right? So we should be expecting price to move higher on this. Note that these things don't always work. They don't always work, right? They don't always work. So we had a head and shoulder. Like I said, they don't always work. Take a look at this head and shoulder. Price didn't drop further, right? It failed. Um, this inverse head and shoulder. What happened? Price moved to the upside, right? Let's scroll back. Let's scroll back. Let's scroll back. So this is a wedge pattern. This is a wedge, right? This is a wedge, and this is a flag, right? You can see how this plays out. Movement wedge to the upside. That's a wedge for bulls, right? All right. This is another wedge, falling wedge. This is a triple bottom. First rejection, second rejection, third rejection. Inside this triple bottom, you can find double bottoms, double bottom, double bottom. This is a double bottom, right? So catalyst for an uptrend, and take a look at this. What do we see? Correction, break above, then take a look at here. What do we have here? A channel. Drag this here. An ascending channel, price dropped. I'm sorry, I have a little bit of a cough. So we had this flag, we had this channel. You know, we had this what do I call it? A wedge. So guys, I told you price is fractal. It's fractal, right? It's very, very fractal. You can find a flag in a wedge. This here is a wedge, right? You can find a flag inside this wedge. So, and then you have this up channel, right? For reversal. Then inside this channel, you can find flags. Inside this channel, you can find flags, and you also have this channel. So I know you must have said we weren't talking about the cup and handle. We're still gonna get there. You wanna know what the cup and handle is? We're gonna get there. We have this triangle. What happened? Price broke above and moved to the upside. I told you guys, price is fractal. You can find one pattern within another pattern, right? So like this triangle pattern now, you can still find a flag inside this pattern, right? You can still find flags. You can find head and shoulder. You can still find this channel pattern here. Um, you have this, and you have this, right? And and you have this. You have this, right? You have this. So, guys, mhm, you can actually say that this is a cup and handle. Let's use this cup um handle, right? Cup handle impulse correction drop. So this is also a pattern, a wedge pattern. This is a wedge. Um, this is a flag. And I told you guys this is fractal. Hey, you're gonna see something that will shock you. It will shock you. You'll be shocked. This is a flag inside a wedge, right? And this is a flag and a wedge inside a channel with the trade touch. One, two, three. The flag with the trade touch. One, two, three. An impulse correction. One, two, three. Price dropped. Impulse correction. Price dropped. Just watch the video on market nature, and in order to trade with these patterns, you need to understand market trend. You need to understand if the market trend is in an uptrend or if it's in a downtrend. You need to understand price trend for you to trade profitably. It gives you a high chance, a high win rate, right? So, and you must keep your risk to reward at 1 to 3 or more. Risking 1% to get 3%. Risking, for example, let's say you took this trade based off 1, 2, 3, or you, okay, let's take this from the break, right? You have 1 to 3 risk to reward. You see, target hit. So that whenever you trade, whenever you trade and you lose 1%, if you hit 1 to 3 risk to reward, the 3% recovers your loss and you still have 2%, right? That's how you do it. That's how you do it. That's how you do it. You don't do it any other way. That's how you do it. So this is a wedge, but let me shock you last. Let me shock you last. This is head and shoulder. So we had much catalyst for a downtrend. We had this ascending channel, we had this head and shoulder, we had this impulse correction, a rising wedge for continuation to the downside. We had this cup, inverse cup, and handle for the downside, right? So we can also say this was a cup and handle, cup, handle. This is the handle. for an upward movement, right? Um, right. So, guys, that's just it, guys. I hope you enjoyed the video. If you did enjoy this video, smash the like button and subscribe, turn on notification bell to get much content like this in the future. Congratulations, guys, you if you got to the end of this video, this 30 minute video. I hope you got so much knowledge. Trade this strategy coupled with strict risk management. Note that I'm not a financial advisor. Whatever I do or say in this video is for educational purpose only. Go and test this for yourself. Don't go out to the market and trade blindly. Don't trade because you heard that this works. Go out, back test, forward test, run demo tests, check this for yourself and know what works for you. Well, we'll see you in the next video, guys. Peace and love.